Buy something you can afford. If anybody pulls your credit, it affects your credit score. When you're looking to buy a house, when you're looking to get financing, when you're looking to get pre-approved, stop buying everything. Don't do it. Hi, this is Damon Gettier with Damon Gettier & Associates, Realtors-Brokered by Real. Today we're going to discuss mortgage pre-approval explained in 5 minutes or less. What is a pre-approval? What is a pre-qual? And there's some differences to it, some nuances to it that you need to know if you're going to be in the home buying world. Let's step back for 1 second and say a pre-qual is a pre-qualification. A pre-qualification is what a lender would send out based on a credit score, and based on what you told me, you qualify to pay X amount. You qualify for this amount of mortgage. That's a pre-qual. Pre-quals aren't really worth the paper they're written on for multiple reasons. Number one, a mortgage company needs to do a tri-merge credit pull. Then you look at all 3 credit bureaus, because what they do is this. Let's just say you have a 650, a 675, and a 770. You have 3, and you're thinking, okay, 770 is really high, I'm gonna be over 700. You're not. They go by the middle score, okay? So if they just pull 1 credit bureau, and that credit bureau is high, you might qualify for more than you should. If they pull 1 credit bureau and that credit bureau is low, you might qualify for less than you really would. So they need to do a tri-merge credit report to find out where your score really is. They pick the middle score, not the average of the 3, not the median. They pick the middle score. The reason they don't do a tri-merge is because they have to pay for them. And it's anywhere from usually $18 to $35 to do a tri-merge credit pull. And a lender, if they don't know if you're going to use them to get a mortgage or not, doesn't want to incur that expense. So you want to do a pre-approval, right? So what you're looking to get is a pre-approval. And a pre-approval would be this. It would be based on your tri-merge credit report, based on your tax returns, based on your income, verified income, and based on your debts. This is what you're pre-approved for. It's a little more in-depth process. It takes a little bit longer to do, but when you go out shopping, you know exactly what you're shopping for, and you know exactly what you can afford. You also know what your payment is. Nobody likes to write an offer on a house, get it under contract, get all the way up to the closing table and find out that $1,900 payment's actually going to be $2,300 because that middle score where we thought it was going to be a 710 is actually a 680. So the documents that the lender's going to look for is going to be pay stubs. They're going to look for a year-to-date pay stub. They're going to look for your last 2 months bank statements. And look, if you have non-sufficient funds on there or an overdraft, you might want to delay it a little bit. Wait till you get past that. They're going to look at your last 60 days pay stubs. They're going to look at your tax returns for the last 2 years. They're also going to need a copy of your driver's license. Because of the Patriots Act, we have to make sure that you are a U.S. citizen. If you're not a U.S. citizen, you can still purchase the house, but there's different rules for you. How does the pre-approval process work? First and foremost, find yourself a local lender. If you're located in Virginia, find a lender in the state of Virginia. Ideally, you would ask your real estate agent, who do you know and trust that does a good job with people like myself? And they will recommend you to a lender that they have used before. We have several that we use. And those lenders, they have a vested interest in doing a great job for that agent because that agent does refer them business, so they're more likely to do a great job with you for them. You'll need to fill out an application. Sometimes you'll do it online with the lender. Sometimes you'll just log in online and do it yourself. I'm a fan of you get on the phone with the lender and you and the lender work together to fill out the form together, because otherwise there's questions they're going to ask that you don't know the answer to, and it becomes a much more elongated process. The lender is then going to run a credit check. He's going to pull your tri-merge credit and see what your middle score is. They're also looking for any red flags. Red flags would be bankruptcies, collections, judgments on your credit. Some of those things can be cleared up. Some of them take a little more trouble to clear up, but oftentimes if there is something on there, they can clear them up. They're looking for red flags. They're also going to look at your debt to income ratio, which is how much debt's on that credit report versus how much income's on that pay stub. And they look for a ratio in there, and different loan programs have different parameters for what that ratio has to be. Once you're pre-approved, typically the pre-approval letter that you get will be good for 90 days. That's your kind of let's go shopping. So call your agent that sent you to that lender, hopefully ours, and say, hey, I'm pre-approved. This is what I can spend up to. This is what I'm looking for, and then go shopping. One thing I would caution you on is when you get that pre-approval, find out what monthly payment comes with it. The only caveat to that is the different counties have different tax rates, and that can change your payment by a couple $100s a month. So depending on what county you look at, it could change the payment you're getting by a couple $100s a month. The next question you're asking is, how much can I get approved for? First and foremost, keep in mind that the pre-approval is pretty close to a guarantee, but it's not a guarantee. And when you are house shopping, I always tell people, you want to buy a nice house, but you don't want to be destined to eat ramen noodles the rest of your life. So buy something you can afford. Buy something that you can see yourself in for the next 5 to 7 years, something that looks comfortable to you, that your family, whether it's shrinking or growing, whichever way it's going, that it's going to adapt to that for the next 5 to 7 years. And then buy something that is affordable for you in that time span. One quick addition to this video I want to put out there for you. When you're looking to buy a house, when you're looking to get financing, when you're looking to get pre-approved, stop buying everything. Don't go online. Don't walk into a Grand Home Furnishing. And the reason is this: if you go into any of these stores, their job is to sell you something. If anybody pulls your credit, it affects your credit score. I want to thank you for watching our video. If you liked it, please like it. Please follow us. Please comment below if you like this video or want to see any more videos like it. For more information or to engage with us further, please follow the Real Estate Success Cast on Facebook. We shall see y'all next time. Thank you. Bye.